Should I raise using a safe or convertible note?
99.9% of the time, you should raise using a safe. Most investors have come around to this being the market standard. SAFE, by the way, stands for Simple Agreement for Future Equity. It is an instrument that was created by actually the investor community, Y Combinator. The philosophy was that investments in early stage companies that are going to be looking to raise venture capital anyway should be treated as equity. They should not be treated as debt. Investors should understand that they're investing in highly risky companies, and they shouldn't be looking for a return that's based on 5 or 6 or 8% interest when the odds that a company is going to be able to make the whatever amount of money they need to pay back the convertible note. Most of these companies are cash burning. They're not profit generating. They won't be able to pay back the note. And if you have a maturity date on a debt instrument of 2 or 3 years later, you're going to find yourself in an issue where investors have leverage and can say, I either want you to pay me back, to buy me out, to give me more. And they put these early stage founders potentially in very difficult positions. So the investment community has coalesced around this idea that early stage investments should be treated as equity. And that's why they're put in the form of a safe, which doesn't have an interest rate, it doesn't have a maturity date, and therefore it's not debt, it's just a contract. By the way, on the investor side, a safe protects investors as well. If the company raises money in an equity financing, it converts into preferred equity that is basically identical to what they raise in the following round, except oftentimes at a discounted price. If the company pays any dividends out, which would be very rare, the investor gets to share in those dividends on an as converted basis. And if the company sells, the investors essentially get what they would take in the company on an as converted basis as well. So all of the necessary investor protections are built into this instrument. So it really is the best thing for both sides.